The average American pays $649,067 in interest over their lifetime. Not their home, not their car, not their education, just the interest. That number is sitting in your future right now, and most people have no idea it is there. This video is going to show you exactly how it gets built. 4 mechanisms, real numbers, and by the end you will understand something most people spend their entire lives paying for without ever once understanding it. Let us start with the number on the advertisement. You walk into a bank. You want a $300,000 mortgage. The rate says 6.5%. You do the math. 6.5% of $300,000 is $19,500 per year. Over 30 years, that feels manageable. Here is what actually happens. Over those 30 years, you do not pay $300,000. You do not pay $358,500. According to a standard amortization schedule at 6.5%, the total interest alone on a $300,000 mortgage comes to $382,633. You borrowed $300,000. You pay back $682,633. The house costs you more than twice what the price tag said. And that is before we get into how that interest is structured. The first mechanism is the one nobody reads in the contract. There are 2 different interest numbers on every loan. Most people only see one of them. The first is called the nominal rate. That is the number on the advertisement, the number the banker quotes, the number that stays in your memory when you leave the building. The second is called the annual percentage rate. It includes the nominal rate plus every fee, every origination charge, every insurance premium, every processing cost that gets bundled into the loan. The law requires lenders to disclose the annual percentage rate. They do, in smaller print, on page 4. After you have already decided you want the loan, here is what that gap looks like in real money. You apply for a $30,000 personal loan at 12%. The bank charges a $300 origination fee, $150 in insurance, and $100 in processing fees. Those costs get added to the loan balance. So you are now paying 12% interest, not on $30,000, but on $30,550. On a 5-year loan at that rate, the extra $550 in principal generates an additional $197 in interest charges. On a $200,000 loan with $4,000 in fees folded in, the same math produces an extra $2,800 in interest you never saw coming. You are paying it. You just agreed to it without knowing what it was. This is not illegal. It is disclosed. It is just disclosed in the language of someone who does not want you to understand it. The second mechanism is where most of the real damage happens. It is compound interest. And it works against borrowers with exactly the same force it works for investors. Simple interest on a loan works like this. You borrow $10,000 at 12% annually. Each month you pay 1% of the original $10,000. That is $100 per month in interest. Nothing changes, flat. Compound interest works differently. You borrow $10,000 at 12% compounded monthly. Month 1, you pay 1% of $10,000, which is $100. But if that $100 is not cleared, next month interest is calculated on $10,100, then on $10,201. The base keeps growing. At the end of 1 year on a 12% nominal rate compounding monthly, the real rate you have paid is 12.68% on $300,000. That gap cost you an extra $2,040 in the first year alone, over 30 years at compound. Interest rates, the difference between the nominal number and the real number, runs into tens of thousands of dollars. Credit cards make this even more visible. The average credit card rate in the United States runs above 21%. At that rate, compounding monthly, if you carry a $5,000 balance and make only the minimum payment, you will pay more than $7,200 in interest before the debt is gone, and it will take more than 17 years to get there. Compound interest is the engine behind every savings account, every investment portfolio, every retirement fund. The exact same engine runs your debt. The only difference is which direction it is pointed. On your investments, it points toward you. On your loans, it points away from you. The third mechanism is the one that moves the most money and gets explained the least. It is called front-loaded amortization. Every month you make a fixed payment. The number on your bank statement never changes. It feels like you are making steady progress. You are not. On a 30-year mortgage at 6%, here is what your first payment looks like. Month 1. Your payment is $1,799. Of that $1,799, exactly $1,500 goes to interest. Only $299 reduces your actual debt. You paid $1,799 and your loan went down by $299. By the end of year 1, you have made 12 payments totaling $21,588. Your loan balance has dropped by $3,371. You paid $18,217 in interest in a single year. Now look at year 18. According to bank rate, on a conventional 30-year fixed loan, the point where more of your monthly payment goes toward principal than interest does not occur until year 18 or 19. For 17 years, more than half of every single payment you made went straight to the bank. Think about what that means in practice. The average American moves or refinances every 7 to 10 years. That means most people never reach the tipping point. They sell the house, pay off the loan, and start a new amortization schedule somewhere else. From month 1 again, the bank collects its most profitable years from every borrower, on every loan every time the cycle resets. On a $400,000 loan at 6%, you pay more than $463,000 in interest over 30 years. You borrowed $400,000. The total cost is $863,000. The bank made more from your loan than you paid for the house. The fourth mechanism is invisible in the contract because it is not in the contract at all. It is the cost of what you gave up. Every dollar you pay in interest is a dollar that cannot grow. You finance $27,000 for a used car at 8.7% over 5.5 years. That is the current national average for a used car loan in America. Total interest paid is $6,800. Now ask a different question. What does $6,800 become if it is invested at 7% annual return over 20 years? The answer is $26,300. You did not just pay $6,800. You surrendered $26,300 in future wealth to finance a car that lost 20% of its value the day you drove it off the lot. Now apply this to the full picture. The average American pays $649,067 in lifetime interest. If even one-third of that amount had been invested at 7% over a 35-year working life, the compound growth produces somewhere between $800,000 and $1.2 million. The average American does not retire with $1.2 million. The gap between what they have and what was possible is sitting right now in a bank's annual report as profit. Here is what changes when you understand these four mechanisms. First, never compare loans using the nominal rate. Compare annual percentage rates. The APR includes all fees and gives you the real cost. A loan with a lower nominal rate and high fees often costs more total money than one with a slightly higher nominal rate and no fees. Second, before signing any large loan, ask the lender for the full amortization schedule. That document shows you exactly how each payment is split between interest and principal month by month. It exists. Lenders are required to produce it. Ask for it every time. Third, on any loan above 7%, paying extra toward the principal is one of the highest return financial moves available. On a 30-year, $300,000 mortgage at 6.5%, adding an extra $200 per month from day one saves $87,000 in total interest and cuts 5 years off the loan term. That is not investing advice. That is arithmetic. Fourth, on any loan with an origination fee, negotiate. That number is almost never fixed. Banks expect borrowers not to ask. Most borrowers do not ask. The ones who do save between fee, and 1.15% fee, percent of the loan amount before signing a single document. Fifth, before financing any depreciating asset, run the opportunity cost first. What does the total interest on this loan become in 20 years at 7% annual return? If the answer changes how you feel about the purchase, that feeling is the correct signal. The bank processes thousands of loans every single day. You will take out a handful of loans in your entire life. That is the information gap. That is where $649,000 goes. Two people start their careers at the same age, same salary, same city. 30 years later, one of them has meaningful wealth. The other is still working. The difference is almost never income. It is almost always the cost of borrowing and the compound growth they surrendered in interest payments. This is not about being intelligent. The borrowers paying the most interest are not unintelligent people. They were never shown how the numbers work. You have seen them now. Share this with one person who is about to finance something. A house, a car, a personal loan. Because this information is worth nothing after the contract is signed. Subscribe to this channel. Because what we do here is explain how money systems actually work. Not how they are sold to you. How they work.